Stocks are soaring and everyone's wondering if we're back in dot-com territory. The difference is today's tech giants actually earned their money. They're not just burning it. Still, as history shows, even the strongest rockets can explode if expectations get too high. We live in interesting times. Private companies are sending rockets into space, but not without risk. I'm sure you've seen one or two of the videos where shiny rockets roar off the launch pad with great hope, only to explode midair just seconds later. Some actually hovered awkwardly for a few moments and finally tip and become engulfed in flames. High hopes and large amounts of capital all erased in a flash. I had a conversation yesterday with Reuters veteran reporter Suzanne McGee, who penned an article with one of my favorites, Chibike Ogu, on high stock valuations and memories of the dot-com bubble. It's a great read, and it's got people talking a lot. Are stocks in a bubble? Well, JP Morgan Chase boss and market whisperer Jamie Dimon certainly thinks so, and he said as much yesterday. His comments reflect a growing concern that stocks keep hitting records, stretching valuations despite a wall of macro and geopolitical headwinds. Yesterday, we talked about gold and stocks hitting new highs, an unlikely duet. Bullish on gold should be the opposite of bullish on stocks, so which is right? Well, that question hangs over the market like a final countdown clock at Cape Canaveral. If you lived through the late 1990s, you remember what a real bubble felt like. The air back then was thick with euphoria. You couldn't swing a Palm Pilot without hitting an IPO straight in the face. Companies with no earnings, sometimes not even revenue, were going public at billion-dollar valuations. The NASDAQ quadrupled between 1995 and 2000 as investors convinced themselves that clicks, eyeballs, and new economy metrics had replaced profits and cash flow. Valuation discipline was a punchline at that point. Analysts who talked about price to earnings were mocked as old economy relics. We were all too busy just watching the countdown clock, waiting for the next hot ticker to blast off. From 1995 through 2000, there were more than 3,400 initial public offerings. 3,400! They had two big surges, one in 95-96, leading up to then Fed Chair Alan Greenspan's irrational exuberance speech, remember that one? And one in 1998-99, right before the pop. Internet stocks were everywhere. IPO filings read like a web directory. Webvan, eToys, InfoSpace, and the iconic Pets.com, which burned through cash faster than its famous sock puppet could wave goodbye. It offered at $11, closed under a dime less than a year later. Some companies survived, Amazon, eBay, Cisco, but most became space debris from that era of hype-fueled capitalism. Fast forward to today, and the scene is very, very different. Expensive? Yeah, for sure, but euphoric? No. Today's tech giants aren't concept stocks. They're global profit engines. NVIDIA, Microsoft, and Palantir, they may trade at premium multiples, but they earn the cash to defend them. The AI revolution isn't a promise of tomorrow. It's a line item in enterprise budgets today. That doesn't mean that there's no speculation. Some recent IPOs like Fermi have that familiar late 1990s glow, a shiny surface polished by perfect pricing and zero profits. And crypto, well, still out there in its own parallel universe, a place where reality occasionally visits but never stays too long. Still, to call the whole market a bubble is to ignore its foundation. Corporate earnings are real. Productivity gains are real. Balance sheets are also strong. The late 90s market was built on narrative. Today's is built on actually numbers. Granted, those numbers aren't cheap, but they're also not fiction. Risks are everywhere. Valuations, concentration, sentiment, I get that, and they're all flashing yellow. But it's muted yellow compared to the blinding neon of 1999. We're not reliving the dot-com mania. We're in an era where innovation is actually cash flow positive. The economy, like those rockets, is fueled by technological ingenuity. But even the best engineered missions can end in fireballs if execution fails or expectations get too far ahead of physics. The difference between then and now is that today's engines are stronger. Profits, productivity, tangible technological progress, not dot-com fairy dust. That doesn't mean that the ride will be smooth. Some of the shiny new rockets will soar, while others will wobble, tilt, and burn. But if investors remember that liftoff isn't the goal, sustainable flight is, we might just avoid the spectacular fireball that ended the last era of irrational exuberance. Alan Greenspan made his irrational exuberance speech on December 5th, 1996. Remember that? The S&P 500 rose 106% after that before the bubble finally burst. So maybe, just maybe, the warning light isn't a stop sign. It's a reminder to check your altitude. So your truth bomb for today is this. We're not living in a bubble. We're living in orbit. And that means gravity still matters. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.